Welcome back to Alternative Realities. I'm David Kelly, Chief Global Strategist here at JP Morgan Asset Management. I'm joined today by our Deputy Head of Private Markets, Brandon Robinson. We're lucky to have him because, by virtue of his role, he has insight into a far larger swath of alternative asset classes than most people. Brandon oversees JP Morgan Asset Management's real estate, real assets, hedge funds, private equity, private credit, and liquid oil solutions. It's a lot to keep track of, so today we're hoping to bring some of the less understood asset classes to life with real examples. Brandon, we're so glad you've joined us. Welcome to Alternative Realities.
Hey, Dr. Kelly, it's happy to be here with you.
Okay, so a lot to cover here, but let's start with real estate. What does the opportunity set look like to you today?
It's a really good question. And I think the operative word is opportunity, because I think right now what we're seeing is a lot of value in opportunistic and in value add real estate. And we're seeing opportunities globally at the moment. So if we started here at home, for example, for me at least, is in the United States, you really need four ingredients roughly for us to have the perfect stew for opportunistic real estate. You need attractive debt spreads. You need predictive or predictable transaction volumes. You need REIT fundamentals to be strong, and then you need capital. Three of those four ingredients we're actually seeing right now in the pot, if you will. So debt spreads are starting to contract. We're starting to see a thawing in transaction volumes across multiple sectors, such as single family rental, multifamily rental, logistics, etc. And we're also starting to see fundamentals in REITs, both public and private, strengthen. Now we just need capital, and we're going to be able to put money to work opportunistically for our clients. We actually recently sold a development that we did down in Fort Worth, Texas, that we started, 28 months prior to that, so ahead of some of the fundamentals that we're seeing today for opportunistic. But the point of bringing this transaction up, where it was a 3-building industrial development, is actually to show that in this environment, we could still get transactions done, and we can do so attractively as long as we know what it is that the market wants, right? And so we were actually able to underwrite this, sell it in 28 months, and generate 19% IRRs and a 1.4 times MOIC, despite the fact that most people are saying, shouldn't be investing in real estate. But right now is a great time to actually be very opportunistic. We're seeing opportunities in Europe as well, particularly in grade A office space, which is, sometimes the dreaded word still is office. Usually when markets are dreaded, they're actually opportunities. And we're seeing that across all of the major markets in Europe. And we're also seeing with the rebound in the retail investor in Europe that e-commerce lends itself to the logistics area for opportunistic investment as well. And then in APAC, I would just point us to Japan. At the end of the day, and I know Japan is in the news a lot lately with rising rates, the carry trade, et cetera. But from a fundamentals perspective, if you can add value and develop multifamily real estate in some of the larger major markets, there's some attractive returns to be had as younger generations are actually densifying. They're going to the Osakas, the Tokyos, et cetera. And development continues to be both robust, but happening at a pace where value add and opportunistic returns are still achievable.
So the way you invest, you're clearly buying the buildings themselves. Just as a matter of interest, how long do you actually hold on to these buildings for?
Since we're talking about the opportunistic space, typically you're going to see anything from 24 to 36 months of ownership of the development, stabilize it to the point where you've got, call it 67, 70%, contracted rent, and then you sell it. Now, it'd be a bit different in core where you're intending on holding the asset for a much longer time period. But what we're actually talking about right now and what we're interested in and where we're seeing the opportunity is in development, in value add, and then selling anywhere from, like I said, 2 to 3 years later.
And given that, how sensitive is your outlook to interest rates? I mean, what happens if interest rates are higher or lower than we expect from here?
Yeah, that's a very good question. At the end of the day, I think the sensitivity interest rate is going to be more or less whether or not you want to be in opportunistic or in core. Real estate is generally an attractive area, diversifier in client portfolios. And so if we were to, for example, as you have started talking about, rate reductions coming, if the path to reduce rates is somewhat smooth and relatively predictable, and debt spreads continue to tighten, we would continue to see opportunities in opportunistic. If it happens much faster, and there's a bit more of a concern about the inflation rate and about the strength of the economy, et cetera, it's a bit of an interesting dynamic where technically investors should probably look more towards core for a little bit higher income, to offset the lower rates in public markets. But at the same time, if people are believing the economy is slowing to a point where rates need to come down significantly, they might be pulling back from real estate markets in general. So it's a bit of a dance that we need to do. But ultimately, I think with the path that we're seeing today, or we're predicting today, where it's relatively smooth declines in rates, opportunistic will continue to be a powerful portfolio addition.
But it sounds like kind of like in a lot of what we do, it's not just a matter of looking at interest rates, but looking at whether the fundamentals really justifying the change in interest rates and sort of working with those two
Exactly.
realities to try to find the best opportunity.
That's
Interesting.
right.
So let's go elsewhere in the real asset space. I mean, obviously, the number one real asset probably is real estate, but what do you think about other real assets here?
Very good question. I mean, look, at the end of the day, we're continuing to see a lot of strength in the infrastructure category within real assets. Now, infrastructure can be categorized as shipping, transportation, or it can be, for example, generation of energy or electricity. It could be distribution of electricity, and it could also be GDP sensitive. Where we're actually seeing a lot of opportunities right now is in contracted power and in distribution. And one of the things that we're keen to focus on is that in order to actually extract value, in other words, higher yields with some capital appreciation, which is our focus area within infrastructure, you really need a couple of factors. You need to own the asset, control it, because at the end of the day, right now we are going through a transition, an energy transition, whether it's the sources that create the electricity or where that electricity goes. We are actually needing to focus on a transition. That means you need long-term strategic thinking and long-term capital flows in order to actually achieve that transition. This isn't something that happens overnight. It's a little bit difficult to do that in a public market context if CEOs have to be focused on quarterly reports and earnings calls, etc., versus in the private market where you can really take a step back, focus on the long-term capex budgeting and strategic planning that is required, and then with private capital, achieve that transition. We actually saw this recently where we took a public company private that's headquartered in Italy that produces renewable energy. We renamed Falk Renewables to Renantis, and then recently merged them with another company that we also owned, Ventient, to produce a large powerhouse company, one of the largest across Europe for renewable energy generation, called Nadarn. And the reason why this is important is because for core stable returns, a scale is required. Scale is possible when you have large operations. Large operations are possible when you have ownership, capital inflow, and expertise in the areas, which is something that we have really focused on our platform.
And so I can see how, I mean, there is a big theme of rising electricity demand because of climate change, because of the energy transition, because of the use of energy in AI and in crypto mining and there are really lots of demands on electricity right now. I think it's a very interesting theme, but do you think it's possible just to use public markets to exploit that theme, or is it better to try and do that through private markets?
Look, at the end of the day, it really depends on what clients are looking for. If clients need or want exposure to infrastructure, but also have more liquidity, it's more of a public market play, right? You buy public utilities or other types of companies. However, if clients can lock up their capital a little bit longer, if they're looking for something that is very diversified or in many cases completely uncorrelated to public markets, private markets is where you're going to want to allocate capital to the extent that you can. Because again, what you're getting from a portfolio construction perspective is uncorrelated returns returns that are similar to that of high yield bonds with some capital appreciation, and you're also getting the ability to allocate capital in your portfolio to something that you can feel and touch, such as the energy transition, which is important to all of us.
Interesting. And I guess I mean clearly there is a premium being paid to private investors for giving up some liquidity here, and I guess that's true in private markets in general. But if we switch to just focus on private markets and particularly private equity or private credit, are there any particular areas within those two spaces that are particularly of particular interest to you right now?
Yeah, I mean, look, at the end of the day, private equity will always be a key allocation in client portfolios where they can get access. But one of the things we're excited about is the diversification that you can find in private credit as well. Whether it's corporate direct lending or I wouldn't describe it as a newer category, but something that has become more in focus for clients is asset-backed lending. As we saw, over the last, call it 24 months, pullback in lending in the commercial banking space in particular, we saw the collapse of a few commercial banks here in the United States, and then just a broad-based pullback in lending. Those consumer borrowers, those that actually are borrowing on behalf of trade finance, they started to look for capital in non-traditional spaces. So these are going to be within structured credit from lenders in the private markets that can actually allocate capital to them. When they did that, it actually produced an attractive opportunity for returns to be diversified, uncorrelated to that of broader direct lending markets, as well as having diversified um, non-blind pool assets in order for them to have stable cash flows and a bit more attractive yield.
Interesting. So you can, I mean, it is a growing and diversifying space. It seems like there's a bigger space growing between banks and bonds here for private lending. Um, when we think about private lending of various kinds, what do you how do you sort of see the pros and cons of that relative to sort of traditional bonds?
Again, I think it goes back a little bit to what I was saying about it depends on what clients are looking for in their portfolio. And even as you say, traditional bonds, is it going to be more of your investment grade or your junk bonds or your high yield bonds, right? Private credit tends to compare better to high yield as opposed to investment grade. It behaves a bit more like the high yield market in terms of having a little bit more correlation to public equity, as well as the yields themselves tend to be higher. And so a client that is already going to be allocating to high yield perhaps should be looking at private credit as a way to diversify, right? So if you have situations such as in 2022, where correlations to public equity start to get a little bit awkward, frankly, and we're still seeing a lot of high volatility, relative high volatility in the fixed income markets, broadly speaking. Private credit can be very attractive where it's less volatile. It has similar, if not higher, yields. Um, and to the extent that you can invest in pools of capital that have already been allocated, such as in private credit secondaries, it can be a really attractive trade off to investing in public high yield markets.
Okay. Let's pivot over to hedge funds here. I mean, there's nothing but diversity in hedge funds, and it's actually, and of course, for a long time, it was a quite difficult space because of very low cash yields, on which you're sort of trying to build some alpha. But where are your managers seeing opportunity in high yield right now?
Yeah, it's a good question.
Sorry,
I
sorry,
mean,
sorry, in hedge funds right now.
yeah, and look, it's a really good question. One of the categories that we've been allocating capital over the last 24 months has actually been in the reinsurance space. It's no longer our top, strategy in terms of where we're putting capital, but over the last 24 months, we've generated significant returns in this space. And what are the dynamics that are happening there? As the effects of climate change have accelerated, depending on how you measure it. Insurance companies had begun to rely on reinsurance companies to backstop their losses. In doing so, premiums increased in the reinsurance space, and those increase in premiums happened in such a compressed period of time that returns became extremely attractive, depending on how you structured the catastrophic risk within a hedge fund portfolio. For example, in one of our portfolios, we generated 28% returns in 2023. We would expect something similar this year. Now that trade is tightening a bit because what we're actually seeing is that reinsurers are starting to, pull back one on policies in general, but also they're not able to take advantage as much of the acceleration in higher premiums because insurance companies themselves have started to say, hold on, that is a bit too pricey. Perhaps we need to pull back. So you have this little bit of an interesting dynamic between supply and demand, both with the insurers and in the reinsurers. That's tightening that trade, but it still is very, very attractive at the moment in the hedge fund space.
Interesting. So one thing I've sort of wondered about, one of the problems I find with alternative investments in general is there's just a huge amount of jargon. And I think for a lot of people who have not traditionally invested a lot in alternatives, it can be a little daunting. And one piece of jargon I want to try and clear up is the whole idea of liquid alts. What would you describe? How would you define a liquid alt?
It's a good question. Typically, liquid alternatives is referring to how much liquidity a client can get from the vehicle in which they are investing. So, for example, if you have an unconstrained bond or an absolute return or a macro opportunities fund that in and of itself can be daily traded or traded with some predictable frequency, it is a liquid alternative to basic public equities. Oftentimes, that phrase liquid alternatives can be confused with, for example, an open-end private markets fund, or it could refer to the liquidity characteristics of the assets within the wrapper itself. But generally speaking, if a firm is talking about liquid alternatives, it's going to be referring to, can an investor get their capital, put their capital in or get it back on a daily basis, and the asset class itself is within the alternative space.
So the way we should think about liquid alternatives is, what's the client experience?
That's right.
Not what the underlying asset is. Okay,
That's
well,
right.
thank you for clearing that up. And then, do you see liquid alts as a broad category having an important role to play in portfolios today?
Certainly. I mean, at the end of the day, take an absolute return, type of a vehicle where, as rates rose and, you wanted to be able to put your cash in something that had a little bit higher return than just basic money market funds, an absolute return liquid fund was actually an attractive area and continues to be an attractive area to put capital. One of the interesting things that you'll see within absolute return is that as they generate cash, they can actually move that cash around in different asset classes, whether it's commercial mortgage lending, other types of private type of lending. They can actually allocate cash as they look at rates, think about the forecast, which direction they're going to go, and which categories become attractive. So it will continue to be a significant contributor to a number of client portfolios.
All right. Well, listen, thank you so much for your time here. Just one last question, Brandon. Um, Broadly speaking, why do you think that investors ought to think about adding an alternative seat to their portfolios right now?
I mean, look, we've heard a lot about the traditional 60/40, and as rates rose, we talked about clients allocating to fit the traditional fixed income markets more and more, and that generated a good trade, for certain investors. But at the end of the day, volatility rose with those higher rates. Public equities, the returns were concentrated to some degree in certain parts of the market. And when you see that concentration in public equities, you see volatility in fixed income markets, your portfolio starts to get a little bit tricky in terms of those correlations and the types of returns you want. So what you can have is a balance in your portfolio where you can generate a little bit lower vol, higher alpha if it, depending on how you construct your portfolio, private equity or private markets, private capital in general can be an interesting place to park capital for a long period of time instead of in public equities. And then against fixed income, there are a number of uncorrelated income generating strategies within private markets, such as I talked about infrastructure and in private credit itself, that can, as I mentioned, be a ballast to that volatility in both rates and in the returns of public fixed income markets.
Interesting. So yeah, and I think obviously that's why we're focusing a lot on this, both in our alternative realities podcast and also in Guide to Alternatives. Listen, Brandon, thank you so much for taking time to talk with us today, and I hope we can have you back.
Thank you. It was a pleasure to be with you today.